Guess who's back? Back again. JD's back. Tell a friend. Oh my gosh, it has been a hot minute since I have done anything YouTube related, TikTok related, PGD Slay related, APC related. I've been on a little bit of a sabbatical. I was finding myself, as they say, trying to figure out who I am, where I want to go, what I want to be, who I want to be. So I was just figuring out all the things, going on a real journey of self discovery. But now that I've settled into what I think I want my life to look like, I'm ready. And I thought we could kick off with a little YouTube video on why you might be failing auditing. So, as a lecturer, the most common, there are very common reasons why people fail auditing. Okay, and my time as a lecturer showed me the most common reasons why people typically fail. The first one being that people don't see the big picture. Okay, so you try to parrot learn auditing, you try to theory dump, regurgitate, and it's just not going to work. Okay, you need to understand where you are in the auditing overview in order to determine how you approach the question. Okay, and the second one is wording. So, wording, because auditing is a language, wording we'll talk about more in the PGD Slay sessions that I'm going to host. So, keep an eye out for those. But today we're going to focus on the big picture. You need to understand where you are fitting in order to understand how to approach the question. So, first things first, we have two different types of audit, right? We have the internal audit and we have the external audit. So, when we are looking at the internal audit, this is usually management or the client's point of view. It's their perspective, it's what's going on in their business that they need to audit internally to manage risks that they are facing, which is known as business risks, right? Then you get the external auditing side. And the external auditing side is looking at it from the audit firm's point of view. So your KPMGs and your PKFs and your EYs and your BDOs, all of those auditing firms, they are external to the company. They come along and they have procedures that they need to do to satisfy the stakeholders. So internal is very much managing what's happening within the business to contain and mitigate the risks that are existing in the business. So looking at it from the perspective of the client, and then the external auditor comes along and they say, okay, well, you've got all of these things in place, but I don't really believe you. You're always sus of the client. I don't think I used that correct. This client is always sus. I don't know. I'm trying to get on board with Gen Z lingo here, but I'm a millennial, so forgive me. So the external auditor comes along and says, okay, cool. Well, we're going to look at your business. We're going to assess our own risks. And then we're going to perform procedures to basically determine whether this risk that we have identified is at an acceptably low level. And if it's not, we're going to raise misstatements. We might even go as far as to modify the audit opinion and say that we don't think that these financial statement line items fairly present, or they do fairly present except for. Okay, but we'll get there. So starting with the internal audit, right? So this is where you will have seen weaknesses and controls. So your weaknesses are your business risks. So this is when you're in the perspective of internal audit. This is anything that can go wrong from a business perspective. It's not necessarily linked only to financial risk. Okay, so when we are talking about business risks, we are very much speaking about financial risks, and we are speaking about operational risks. So here you can see we've got a little bit of an overlap with Manfin. And this is the other thing that you need to get very comfortable with, is that you cannot view these subjects in isolation. Oh, no, 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 no. Because they can ask you to come up with controls over the consolidation process. Now, if you don't understand the FINAC behind consolidation, you're going to struggle. Okay, they can ask you to audit the deferred tax balance in the financial statements. And if you don't understand IAS 12 and your tax knowledge is also lacking, you're going to have a hard time. So stop thinking in isolation. You need to get comfortable integrating these subjects because you will see a lot of that. Okay, so still in the lane of internal, we have got our weaknesses. Our weaknesses are our business risks. Now, internally, as management, as the client, we want to mitigate those risks, right? So we're putting ourselves in the position of the FM, of the CFO, and we're going, okay, there's a chance we could lose customers to competitors because of XYZ. Oh, there's a chance that this is not calculated correctly because of XYZ. Okay, so we're identifying these business risks, and then we come along and we come up with controls, and those controls address those weaknesses or those business risks, right? Now, your controls get broken down into key financial controls and then your supporting or complementary controls. So your key financial controls, those are directly linked to, you guessed it, your financial statements. Okay, so they have a direct impact on the line item amount that is sitting in your financial statements, or they could even impact the disclosure. So just remember that when we're dealing with financial statements, we've got the face of the statement, okay, and then we've also got our disclosure. Okay, so key controls can speak to either of those two. Can you see why we need to also understand FNAC here? Yeah, it's haunting, I know. And then we've got our supporting or our complementary controls that don't really directly link to the financial statements, but they rather support the key financial controls. Now, these controls, you will recognize caviar, okay, completeness, accuracy, validity, and restriction of access. I was trying to overlap there. It's obviously been a while since I've done this, so I'm slightly nervous. Okay, so completeness is saying everything that should be in the financial statements is in the financial statements. Okay, accuracy is saying the correct amounts are recorded in the correct accounts. Validity is saying these things are real, these transactions are real, they exist. And restriction of access is saying, okay, there's no one that can come along and process fictitious transactions, which is going to affect my validity, or they can go and change amounts, which will affect my accuracy, or they can omit certain transactions, which will affect my completeness. Okay, so you can't see these things in isolation. So when it comes to the wording for your weaknesses, okay, we're going trigger and effect. Trigger is what could go wrong, okay? So there's a chance that because no contracts are signed, that's going to lead to disputes. Remember, we're putting ourselves internally. We're not necessarily focusing on financial controls now, but there could be disputes in terms of the CCMA, and then the company might lose money if they lose this court case, just as an example. Okay, so what could go wrong? So we have the absence of the contract being signed by both the company and the employee when somebody is hired in the HR cycle. But then we also need to think about the effect. So what are the consequences of this? And that's where we're going to potentially be in the CCMA. There's going to be an outflow of funds if an employee, a disgruntled employee, does take us to the CCMA and we lose the case. Okay, so there is a business risk, not necessarily linked to the financial statements and the processing thereof, but looking at a business risk and then coming up with the consequences to explain why it is a weakness. So you have to have these two things. So what is the thing that's going wrong or could go wrong, or what's missing, what is incorrect? So that's another way that we can think of it, is to say, okay, missing or explicitly wrong. And it's always the missing ones that are going to get you. Trust me. The explicitly wrong ones, those days are gone. That's undergrad. Okay, and then the effect is, what are the consequences? Now, when I was a lecturer, I always saw that people forgot this one. Okay, so when you have a weakness question, you say something like, there is a lack of segregation of duties. I'm not going to give you a mark because you've only given me half of the answer. I need to know, okay, so if there's a lack of segregation of duties, what are the consequences of that? What is going to follow that's so negative that makes this a weakness? Okay, then when it comes to our controls, okay, what is the control? And then what does it aim to prevent, detect, or correct? Okay, so again, you might recommend something like, there should be A more senior person reviewing the reconciliation. Again, you're not going to get the mark because you're giving me what is the control, but you're not telling me what does it aim to prevent, detect, or correct. So another person, a more senior person reviewing a reconciliation, that is going to detect if there are any incorrect amounts that have been included or things that have been missed. Okay. So that is the internal piece. And of course, with our internal piece, this is where you are going to see your cycles. Okay, this is where you're going to see your revenue and receipts. This is where you're going to see your purchases and payments. This is where you're going to see your inventory cycle. This is where you're going to see your HR cycle. Okay, so this is where all of your cycles are going to come to life, as well is when you are identifying weaknesses and recommending controls, right? Now, we do also see the cycles when we get to the external audit, but whether we are actually going to immerse ourselves in the cycles when it comes to external audit is going to depend on the audit approach that we take. So whether we are testing controls or not. So I'm hoping this is kind of coming together now. Okay, so thinking about the external, you can see that external looks quite different to internal, right? And that's because when we are looking at external audit, there are 4 main phases that we need to think about: pre-engagement, planning, gathering evidence, and then reporting and concluding. If you understand what the purpose of an external audit is, you will be able to very easily know where you are sitting, right? Whether you are sitting in management's seat and thinking from their perspective, or whether you're sitting in the external audit firm's seat and thinking from their perspective. Now, the purpose of an external audit is obviously to express an opinion. And that opinion is going to tell the users of the financial statements whether the financial statements are free from material misstatements. Okay. So when you think about it from that perspective, what the end goal of the external audit is, all of these phases make sense. Okay. So pre-engagement is saying, we've got these conditions that we have to meet. Are they met? Because if they're not met, then we're not in compliance with the ISAs and we should probably stop right there. Okay, and then we also need to do these things called acceptance and continuance procedures. So this is where we, as the audit firm, decide whether we want to accept this client, okay? Because there might be things that make us go, oh, don't know if I want to take on this client. And it's quite logical, right? So would you, if you owned a business, would you want a client that has the risk of not paying you? No. Same thing with an audit firm. Remember, an audit firm is a business at the end of the day. They are profit seeking. That's another debate on whether they should be profit seeking in the pursuit of public interest, but we'll talk about that one day. Okay, then can I accept the client? Do I actually have the resources in my audit firm to be able to take on the client? Is it ethical to accept this client? And ethical here is where we are going to go to our CPC. Okay, and that's another thing you need to remember. So CPC can also apply when we are looking at the internal audit side, right? And the CPC will apply here if we have any CASAs within the company. Okay, so this misconception that CPC only applies to auditors, no. If you have a CFOs or CASA, that's internal audit. They are identifying weaknesses and implementing controls. CPC also applies to them. Okay, so we think about whether it is ethical and then whether it is legal. Remember that there are certain Companies Act requirements that we need to adhere to, specifically when it comes to a legal vacancy. But we'll touch more on all of these things in detail as we move through the series, the auditing series. Okay, then we've got our planning stage, and the planning stage happens, there's a lot happening there. So we've got our risk assessment. Now, this might sound familiar to the internal audit where we also identify risks, okay? But remember, with an external audit, we can't go and identify every single risk that exists, right? We basically have to find the most significant risks, okay? And we go and design procedures to test whether those risks are at an acceptably low level, okay? Because remember, and again, we'll talk more about this in detail, But we have this thing called audit risk, and audit risk is the risk that we express the wrong opinion. Audit risk is made up of our inherent risk and our control risk, okay, and our detection risk. Okay, so our inherent risk and our control risk, that's our ROM. And then our detection risk, that is going to be from the auditor's perspective. That's the risk that we are not going to detect misstatements. Okay. So the only one that we can control to reduce the risk that we express the incorrect opinion is this one. We cannot go and change the inherent risks that are present within the company we are auditing. We also can't go and change their controls. Okay, so the only one that we can influence is our detection risk. We have control over that. So we use our detection risk to bring our audit risk to an acceptably low level. And that is obviously reducing the risk that we express the wrong opinion. Okay, so with our risk assessment, we've got two important ROMs that we take a look at, our overall financial statement level and our assertion level. Okay, they are very similar, except that overall financial statement level means that the risk is so big that it affects multiple items, line items in the financial statements. So your effect has to link to the financial statements as a whole. Whereas your assertion level is zooming in on a specific line item and saying, okay, the effect now needs to link to that line item. And very importantly, I have to give an assertion. So do you see the difference between ROM and between our weaknesses or our business risks? Okay, there's like extra steps. Okay. We've got our audit strategy, audit plan. We'll speak about all of these things in more detail as we work through the process. And then we've got our gather evidence phase. Okay, so when we are coming up with our audit plan, we are going to decide on the audit approach to use. Okay, and basically our audit approach is either going to be controls based or it's going to be wholly substantive. And what's going to influence the approach that we take? Ding, ding, ding. It is the risk assessment, because our procedures have to respond to our risk, because that's going to make us satisfied that our audit risk is at an acceptably low level. Okay. So when we are gathering evidence, we can either do this through testing our controls, depending on the audit approach that we've selected. And you'll see the wording here is different to when we are recommending controls. It's very different, because here we have to do something to something for a purpose. Here we have to use audit verbs. We have to mention the source document that we're testing, and we have to link it to the assertion that we are trying to get comfort over. Okay, so I hope you've seen the difference between business risks and ROM, and between recommending controls and test of controls, because that's where a lot of people don't understand the difference. And it's just a matter of perspective and understanding that an external audit is governed by the ISAs. The ISAs prescribe certain wording when it comes to our procedures. Okay. And then our last phase is the concluding and reporting phase. That's where we are going to form an opinion based on everything we've done in the prior steps. And we're going to issue an audit report that might have extra sections in it depending on what we have found. Okay, so I hope this sort of broad overview helps you to understand a little bit that you need to identify which position you are in order to know what, or how rather, to approach the answer that you're giving. And it's also going to influence the wording that you need to implement. Cool, I'm excited to do more of these videos, but I hope this was useful. See you next time.